Hello everyone, I am Jeel Shah from WealthTrust Capital Services. We are here to walk you through our Cyclical Opportunities Smallcase, an investment strategy designed to capture the sectoral and economic cycles. With that, let's dive right in. Over to you, Sneha.
Thank you, Jill, so much. And hello, everyone. I'm very excited to take you through what we do at WealthTrust Capital Services, what our overall strategy looks like, and how have we designed this particular small case. So we'll dive right in. So, what exactly are we doing, right? We're first trying to decode the market dynamics. Now, any economy or any business, right, has three cycles that they go through. One is or are dependent on. One is the economical, what is the economic cycle? Whether we are in a growth, we are a growth country, a Japan could be, a stagnant country. So it depends on various country level also, right? Whether what country, where are you in terms of growth? So particularly India is a growth economy or a developing economy in that sense. Then we get into the sector cycles, whether within the economy, what is the focus on that sector? Because every economy would have three, four sectors where there's a lot of growth or could have cycles where there is growth in a particular sector and then there's growth in a second sector, etc. Of course, it's also all linked to government agendas, and what the government thinks is something that we should grow our all the kind of capabilities that the country has, and those sectors work also on that, or also could be on commodity cycles, etc. What is the underlying price of the commodities, and how that sector is kind of performing. And then we come to the business cycle. So every business also has a cycle in terms of whether it's an introduction like a startup, or it's something where it has reached a beyond growth. I mean, they need to pivot to kind of make sense of the business. So we get into that cycle. So basically the approach is top down, where you kind of look at what the economy is doing, where the focus of the government is, which sectors will do definitely well in the next 3 to 5 years. That's how we look at it from a top-down approach. And once we finalize which sectors we believe will do really well, we get into the bottom-up approach, where basically we start seeing within those sectors that we pick, we start seeing the companies from a very, very bottom-up angle. Now, when we look at bottom-up, right, a lot of factors come in place. One very essential one is corporate governance, how the promoters are, whether they really believe in the kind of business they are running. Then we look at, of course, growth in terms of the earnings, the PAT, all kind of bottom up research we deep dive into. And once it kind of makes sense from a valuation perspective, from a earnings perspective, we jump in and buy the stock. So this is largely how the market dynamics function and what our strategy looks like within those market dynamics and how we like to capture it. Now let's step back a little bit. Why do we think this is important, or why should we do it in this format? So let's look at any economic cycle, right? Let's go back a bit, maybe 20 years, and let's look at the Indian economic cycle. So if you go to see the gray line, right, what we see is that any economy which is in a growth stage basically has a very linear progression. But if you see those graphs, right, which are behind, what is it showing? That each economy could have a growing or a very linear progression towards how it grows. So the demand is increasing, the GDP is doing well, there is enough growth in the economy. But there will be setbacks, and there will be sectors or times when that particular sector or the businesses will not do well, and that's when we see there is that volatility within. So like we saw the global financial crisis, all sectors, all businesses were impacted, But then if we see there was a reversal and some sectors and some businesses kind of did better than the others. So if you go to see, there is that kind of volatility within the businesses and the sectors that kind of shows, yes, in a more longer term, we see markets usually following a linear progression. But when we look at economies and when we look at the businesses and the sectors, there is volatility. And after in economic cycles, usually, especially during some big government growth periods, or a global financial crisis or a pandemic, we've seen markets correcting. And if you of course entered at the right time, these are things you can kind of relate to. But this even happens at a sector level. So there could be a good some big correction because of some geopolitical or global crisis, etc. And if you get in that sector at the right time, right, the kind of pricing you get in at and the valuation you get in at, you can get really rewarded for the time you get into that particular business. So this kind of shows you that. And taking this to a particular example, I will take you on the next slide. So let's look at this sector cycle, right? It is more linked to commodity, which is like a price of steel. So basically, what is the steel price? That was the underlying steel price. So what happens? Usually, how do businesses function? So let's, for example, take Tata Steel, right? Uh, Growing economies, urbanization, there'll be more homes built, etc. So you will need more steel to kind of build more homes. There will be a lot of demand. So if you go to see, the demand has kept increasing, right, which is the blue line. But when you look at the graph, right, what are we seeing? So the graph is where it shows that the demand is it keeps increasing. So the demand has not reduced over the years. But what happens is the price of steel shows you whether the overall growth of that particular stock is going to happen or not. And why does that happen? Because the steel prices must have reduced, because maybe like last 3 years, right, where China was dumping a lot of steel into India. So of course the steel prices corrected a lot, and then in that case, the bottom, from the company's angle, right, it wouldn't actually give you that reward, because you were in a cycle where steel prices were going down. But even though there is demand, you're not ending up making that much money. So very very simply put, that's the reason that you see over time the demand is increasing. But if you're not in a particular stock at the right time, it may not help you in terms of, you have not captured the cycle and you've gotten at a time, even though it's a great company, everything works well, bottom up, everything is doing well, the demand is increasing. But because of these external factors, which you've not taken care of, then the getting into even a good company at a bad time won't reward. And that's exactly what we kind of go for, or we check. And that's when we get into a particular sector or cycle, when we see there is a turnaround in terms of demand, of course, being there, but also the pricing being something that can deliver within the books. That's the idea. So, very, very, very important example to do with this could be like an Infosys story, right? Great company. We saw the IT boom. If in in a time, so every company goes through, 4 phases, right? One is introduction, then there is the growth phase. So if you get into the growth phase, of course, you will, get really rewarded within the company. Like, of course, now looking back, we can say, okay, wait, if we had invested in Infosys or the IT boom, but that could be today also. There'll be many businesses which We don't anticipate to do so well in the future, and that's where the research comes in. So let's say if you got into a business with great, superb growth, the business net profit have been increasing by 52%. But let's say now it's come in a matured phase. At that time, what happens, even though there is very good profit growth, etc., the valuations get stretched so much, which you can see in the next slide. Jill, can you pass over? So from the period of 99, right, and until 2005, so anybody who had gotten at that IT boom time when the markets were loving Infosys as being one of the best investments, etc. If you had gotten at a time when when Infosys valuation was very stretched, at that time, if you had gotten, you would have wait till 2005 to get back to that price. That's basically a valuation stretch. So even if it's a great company, the profits are increasing every year. Everything is looking good. The growth is good, but it will probably not be a good part of your portfolio because the valuation is stretched. And even though everything was right in this company, in 6 years also you would have taken to recover the price it was at. So that's why valuation is a very important matrix in analyzing, even though everything could be good from a bottom up angle. If the valuation is stretched, it may not be a good part to your portfolio. And that's something we really take care of in cyclical kind of opportunities, small case, where we look for ideas where the valuation is not stretched. Of course, that not being the only parameter, but this is an example to kind of tell even a good growth company can, if it's in the maturity stage, it may not add up to keep just buying that stock. And this is just to kind of show you, how the valuations can prove to be a very, very important aspect. It's basically the cost of overpaying and the risk of high PE stocks. You overpaid for a stock and then you have to wait for a long time for its stock price to correct. So, what's our approach to valuations and why do we give it a lot of importance? Is because we feel if earnings are rising and if valuations are aligned, then of course the wealth will really compound, and that's when we would like to, buy a stock. What the two important aspects when we look at sectors and when we look at the cycle to turn, we feel that if the cycle has turned and the valuation expansion is going to happen within that particular sector and that particular business. So and then we are seeing that when we are doing the bottom up research that there is profit growth and every year this company is growing by the expectation that we have, and their valuation is going to expand. That's the time we believe that that stock has the potential for multi-fold returns, and that's the time it will actually come or be part of this portfolio. So also, to just put a point, a lot of people then just look at PE to invest or, look at the valuations and then decide, oh, PE is at an X value, and they'll then never get into that company. But what happens is like, even for like companies like Zomato, it was always trading at a high PE, right? But it did see expansion. There was volume growth. So it did do really well in those times also. So it's very important to understand that that cannot be the only factor to kind of figure whether we want to buy the stock or not. So it's very important to understand what does this valuation trap mean, and in what kind of companies one needs to see it. If for Infosys, it was when the company was already at maturity stage, but let's say the business had pivoted. Okay, and then there could be a valuation expansion. So it also depends at the cycle of that company. Even though valuations are stretched at times, what cycle are you kind of getting in that company, and is there potential for profit growth plus expansion of valuation because of the underlying particular sector cycle, or the consumer behavior, the economic cycle supporting it, and then comes the bottom up. So those two factors have to blend in really well to not be in a valuation trap where you just miss a stock because it's very high PE. That's not the idea, at least we look at. Um, so why, and usually we believe that, when the overall markets, right, are going for correction, the valuations will usually go down. But when the sectors are going into corrections, right, there could be that the broader market is rallying, but the valuations would go down for that particular sector because there's a business correction or a sector correction in general, because that particular sector is not doing well. And that's also how you need to look at, or at least how we look at, the whole valuation spectrum. You can go ahead. So we showed you valuation against the economic cycle, where if your broader market is going, is expected to do well. Not all sectors will follow. It will also depend on, there could be some sectors which will go through correction, etc. Also depends, like for example, during the COVID, right? After COVID, we saw a huge demand from a consumption story, and then there was a slump in terms of, the rural economy recovery. So though there could be this is a sector example where basically you have a pandemic, then you have instant demand, and then there is correction within that sector because of high valuation within that space, and then there is recovery. So it depends again at what time are you capturing that cycle and getting into that cycle at a time where you actually expect recovery due to the overall numbers and the overall economic cycle. And that's basically how any of the top down and bottom up will work, where we look at overall economic cycle. So in a pandemic, right, most industries kind of had a slowdown, but then there was liquidity due to, people putting more money in the market. So it again, that whole cycle and the economic cycle makes kind of whether that sector has actual demand and is moving up, or there is any change in that particular sector, or there is, it has really hit its rock bottom, and then we expect the numbers to start showing up well from the next quarters, etc. So, as I said, the main thing of this cyclical opportunities fund that we have is we look at three main cycles, which is the economic cycle, the sector cycle, and the business cycle. Once we have figured in the overall economic cycle, what are the sectors which have more potential for growth? There will always be two, three, like even in a boom market, right? When most things do well, there will always be sectors which will do better than the other. Like, back in 2023, we saw infrastructure doing very well because there was a lot of focus by the government on capital, on infusing capital, etc. And then it changed to, from a broad sector perspective. So then it changed to banking in 2024, where we saw a lot of banking was very undervalued because it had just not moved the last 3 years when the overall market was in boom. And then, so that's how basically, the economic cycle also turns. And that's when we identify the sectors. And from today, if we look at, various sectors, how for example, a company, right, could be in a pivot stage, even like an IT company. So if they are in a sector cycle where, there is economic cycle is good, it's looking, growth oriented, but we see a sector which is, which is also doing well. But from a bottom-up approach, when we see that the business is also pivoted, right, to kind of take advantage of the sector cycle that is available, because not all companies may be able to take that advantage. So the pivot in the business could also help that particular, when we do the bottom-up approach, that's when the business cycle also matters, because it doesn't mean if your sector is in a good phase, all companies may actually do well in that phase, because they have to also be able to take advantage or be in the right place, within that business matrix to take advantage of that business. For example, CDMO. So all pharma companies, we may not have the specialty or the kind of the kind of capability to set up the CDMO. So only companies who could probably pivot in that, and if there is a sector boom in the CDMO space, they will be the ones who will be able to take the advantage, and that's where the bottom up research comes in, where we are able to take advantage of those particular stocks. Yeah, so that's about it from my end. I will tell Shubham to now step in and give us a few examples on how we build the cyclical turnaround stories, and maybe some stocks on some examples on stocks as to how we've actually been able to capture what I discussed. Thank you.
Yeah. As Neha rightly said, right, that we don't chase momentum, or we don't try to time the top or the bottom. We look for fundamentally strong businesses, but businesses that are temporarily going through a bad phase. There are companies where earnings may be suppressed or sentiments could be weak, or there could be a sectoral, headwinds, but the core business should remain intact. That's the main motive. The this phase of underperformance always benefit us, because we enter at the very starting stage, and when the cycles begins to turn, we don't just get the benefits from earning growth, and we also get benefit from the value re-rating, as Neha has discussed in the past. So let me illustrate this with a real example. KRBL is a market leader in the basmati rice segment. What I remember, back in 15-16, India saw back-to-back deficit monsoon. 11 states were officially drought hit, and agriculture productivity was very low. Demand was very low. People were worried about basmati companies, rice companies, and investor expectations started. Investor expectations were muted. So. Because of that, every company in basmati space like LT Foods or KRBL, valuation started going down. The share corrected a lot, but it was just because of a temporary weather linked disruption. So we saw this as a classic case of good business in a bad phase, and that's exactly where we entered. So, interestingly, the very next year, the Indian Meteorological Department forecasted and delivered that a normal to above normal monsoon is expected, and crop yields improved, supply improved slowly and steadily. The revenues of KRBL also started recovering, and that was a turnaround for the company. KRBL business model started improving, numbers improved, and at the end, earnings also started improving. So as a result, KRBL delivered over around 70% during that period of time, and that was driven by two key contributors. The first one was cash EPS, which grew by 34%. Uh, Now the second point, P multiple also expanded by 38%. So whenever whenever we entered at this phases of companies where there could be a temporary shock, or the major fundamental problem isn't there in the business, we always get benefit of valuation re-rating, as well as the earning, as well as the EPS. So next slide, Ajay. Yes, as you can see, right, the impact slowly and steadily, the rain, as meteorological department, predicted that the rainfall would be normalized in the coming years. KRBL started, increasing their revenue, the PAT margin increased, and that was the reason where valuation re-rating slowly started, and the share price jumped by 70%. As I said, right, EPS growth also increased 34%, PE growth also increased, and there was a value re-rating, which at the end resulted up to 70% returns in KRBL, back in 1.5 year, down. So yes, there was additionally, if you will see, right, KRBL didn't just recover because it evolved. They also begin transitioning from their product portfolio, as Sneha ma'am discussed, right, in the past, that it's not about we pick a company which is at their 52-week low, or it's just because the company has been corrected, or the sector is at the all-time low. The shift from high volume to high margin business is the main growth trigger. KRBL volume wouldn't be the only factor where the company may drive further. They also started, evolving their product portfolio. They also started focusing much on the margin expansion on the product, which could create an extra margin, and this really helped the company for the longer period of time. A similar story, played out in Maruti Suzuki as well. Traditionally positioned around, affordability and efficiency, Maruti realized that Indian consumers were evolving. It's not about they, because if you will see in in the first 3 to 4 years, the margins were low. Then, but they realized that but the Indian consumers now are demanding aspirational features, superior designs and better owner experience. So Maruti responded itself, with premium interiors, new product lines. They also entered into SUV markets, and slowly and steadily this change really helped the business. You can see the margins expansion of Maruti Suzuki, and this is also an important factor when we consider a company. It's as I said again, it's not about just because the sector is down or if the company has corrected. We need to see, is there any transactional change, or is the product portfolio is changing, because those factors matters a lot whenever there is a turnaround story. So Maruti Suzuki was a live example, is a live case study where we picked this company because there was a transactional shift in the cosmetic change. This resulted because of the changes, because they understood that the consumers are evolving. They started premiumizing the cars, and this resulted in the margin expansion. So this is a case study where if a company add to their value products, those will always increase to margin expansion. Now, so now let's discuss about the steel sector space, which is currently going through a very difficult phase. So in 2021, right, HRC steel prices have been consistently declining. Everybody know because in Chinese steel exports to India. China's ability to undercut price is very well known all over the world. Backed by state subsidies, lower energy costs, they have a huge manufacturing capacity. This has directly impacted to the Indian steel companies, and that's the reason you can see in the last 1 to 2 years steel prices has been very low, and this is hurting a lot of steel companies and metal companies. I'll like to discuss about a case study about a company. G AP Apollo Tube is a standout example. They hold a dominant 55% market share in the structural steel tubes. A key component in India's infras and construction push. So this is an example again, as we said, that it's just 1 quarter. The stock P jumped from 58x to 2072x. But everybody assumes that this could be just because of the price appreciation, but this wasn't because of the price appreciation. It was because earning temporarily collapsed due to an inventory loss happened of around 2000 per ton. So what happens every time whenever the P increase from substantial value to an X value, people always assume it's because of the price appreciation. But most of the time, in this case in AP Apollo Tube, right, it wasn't because of the price appreciation. It was because of the loss of earning temporary. But it is a temporary loss. Now traditionally investors always avoid investing in high PE stocks, but we look deeper and deeper about the business model. We studied about the business stage, the inventory, and demand visibility was very strong for this company. The margin hit, it is very temporary, and we took a contrarian view, and then we entered to a phase where there is a mispricing. There are always companies where market always mispriced because of some of the temporary reason, as we discussed in KRBL. When there was a drought situation in many of the states, market started mispricing, and all the rice companies, all the basmati companies were at their all-time low. And the same case is happening with AP Apollo tubes currently, just because of steel prices is going down. China's ability to undercut price is increasing. That's why you will see many of the steel companies is facing the heat, and the valuation is correcting. But the case with AP Apollo tube is a bit different. That's the reason we are discussing about it today. Recently, Indian Director General of Trade Remedies, has proposed a 12% safeguard duty on certain steel imports, especially from China. So this will have two impact. First, it will make Indian steel more competitive. This will allow margins to recover slowly and steadily. And the second, it act as a powerful catalyst for valuation. So if you will see from the last 6 to 7 months, all the steel companies has started recovering because government has taken this step. So this is a classic setup where we saw a macro headwinds ease, earning begins to normalize, and then there could be a sentiment shift. So we are entering at a very early stage, but as we discussed, right, that you need a growth trigger. It's not there was no fundamental issue with the company, there was no corporate governance issue with the company. It was just a temporary shock because of China. But yeah, if government is taking the right step, we could see that this could slowly and steadily help the company grow in the coming quarters, and then there could be a re-rating in the valuation, and then you can see a cycle turnaround for this company. So to summarize, our approach is just not about identifying value, or it's about identifying value with context. We as I said earlier, right, that we just don't buy cheap stocks, or we don't start looking at the companies which are at to their 52-week low, or the sectors which are at 52-week low. We buy good businesses that the market has misunderstood, or prematurely written off due to the temporary headwinds. As this headwind slowly and steadily fades away, with the case of AP Apollo tube and with the case of KRBL, which happened in the past, the business not only recovered but it transform, and we benefit both from the return of fundamental as well as from the re-rating with the re-rating of the companies. So this philosophy of combining economic, then sectoral and business cycle is embedded, across our portfolio in cyclical opportunities, and that's how we aim to generate a sustainable alpha across cycle sectors and strategies. What do you say, ma'am?
Also, to kind of conclude, thank you everyone. If you have any questions, do reach out and we'll be happy to answer any of them. Thank you.